All right, hey, what's going on, everybody? So thanks for tuning in. So just a quick introduction. So this is the sprint review. So it's a live stream that I do every couple weeks. I'll admit I totally just threw this one together. So this is going to be a pretty laid back version of it. So quick intro. So my name is Mike Zung. I'm a certified financial planner, and I'm the founder of a fee-only financial planning firm called Java Wealth. I'm based in Kansas City, but I work with people virtually all over the country. And I focus on people with equity compensation. So a lot of tech professionals, because that's the world that I came from. And so yeah, that's just a super quick thing about me. And so today, what we're going to talk about with what's going on in the world of the stock market is what happens if your company, if the company that you work for, if the stock is falling. So what does that mean to your RSUs, to your ESPP, or your stock options? So yeah, I know that right now with with the fact that the market, it's been doing well for a long time, right? Especially tech companies have been doing really well. But then just in the last month or so, that all the tech stocks, they're not doing so hot, right? And so from the perspective of the general stock market and retirement accounts and things like that, the messaging is very rightfully so. It's just like, hey, stay the course. This is long term. That you don't check the stock, don't look at your portfolio, that kind of stuff. But for tech professionals, people that are in the tech world, a lot of your compensation is in the form of your own company stock, and so these kinds of swings can greatly change what happens to your current world. It's pretty much impossible to just say, oh, I'm just going to completely ignore it. So I figured that I would do this quick live stream to try to talk through some of that, and just to talk through what it means. And what I'm going to do is I'm going to go through each type of equity compensation, and to just talk through a little bit about what it means if your company stock, it used to be, it was up here, and now maybe it's been cut in half. I mean, because there's a lot of the companies like, just thinking of like Peloton, Coinbase, stuff like that, where it's gone down significantly, right? And it can be a very anxiety-inducing feeling to be part of it, right? So this is a live stream, so for anybody that's watching, feel free to put a comment in there. If you have any sort of questions, then I'll try to get them answered live here. And I'm not sure if I'm going to do much whiteboarding, but we'll figure it out. So first, let's talk about RSUs. So just a super quick intro for RSUs is that, like, so this is stock that is being promised to you, and it's going to vest over a certain period, right? Yeah, let's go ahead and whiteboard some stuff here. I'm gonna switch to the whiteboard view where we're zoomed in a little bit more. Okay, so for RSUs, make sure I'm fitting okay. That basically you're granted RSUs, and then they're going to vest at certain times, right? And so in a particular RSU grant, you get a certain number. So we're just, for round numbers, we're going to say you get 4,000 RSUs, right? And then so what's going to happen and just again for the sake of ease, that they're granted every year for the next 4 years. So you're going to get 1,000 RSUs each time, right? And so with that, the number of RSUs is already set, but the way that it's going to work from a tax perspective and just the value of them, like, it all depends on what the stock price is whenever the RSUs vest, right? And so like in this example, that with each time, whatever that price is, the day that it vests, then that is this amount is considered income to you. right? So just whatever that gap is. So you just take the number of RSUs times the price of the stock on that date, and that is considered taxable ordinary, that's considered ordinary income to you. So another way to think about it is as if you just got a cash bonus, right? And that was the amount of your cash bonus, right? So now that we have that, so what happened is that, the stock prices have been going up, and so maybe last year the RSUs that vested, we'll just say here it was, I don't know, $100, right? So here, whenever you have your 1,000 RSUs that vested at $100, so I mean I'm doing the math right. What, 100 grand, right? Yeah, geez, awesome. So then that's considered, you're getting that much income, but then whenever your stock goes down, and then the next grant, it's still going to be 1,000 RSUs that are going to vest, but then the amount of like the size of your bonus check just got cut a lot, right? So in that scenario, there's really, with RSUs, there's really not much that you can do about it. It's part of the risk of having some of your equity or some of your compensation tied up in your own company, right? And so as far as what you can do is that's the income, and it can be human nature to say, well, since my stock price is down, then I don't want to sell my RSUs whenever they vest, right? And while that could very well be the case, it still goes back to to asking yourself the question of whenever on that vesting date, if you instead got a cash bonus, and then that money, that cash hit your checking account, would you turn around and go buy your company stock with all of that money, right? So answer that question for yourself. And if the answer is no, if I had, so in this example, if it got cut in half and it's $50 a share now, and then so you got 50 grand, of course after tax it would be like 35 grand or something. If you had $35,000 in cash in your checking account, would you go out and buy your company stock with all of that, right? And then yeah, if the answer is no, then actually selling it would be that's another way of just saying that yes, let's just go ahead and sell it right now, right? So yeah, that's first RSUs that have already been granted to you, right? But the silver lining of what could possibly happen is for new RSU grants. And so with RSU grants, what companies often do is they'll grant them to you in a dollar amount, right? So for example, I guess we'll just take this particular example of whenever you get this new grant, then your company is going to say, hey, I'm going to grant you, $100,000 worth of RSUs, right? And so the way that would actually work is they'll just take $100,000 and divide it by whatever the stock price is at the time, and then that determines how many RSUs you get from that. So again, the kind of making lemonade out of lemons part of this is that with the stock price dipping, any new RSU grants, you'll actually get more RSUs from that grant because the denominator, what you're dividing your cash equivalent amount by, is a smaller number, and so you'll get more RSUs from that. Okay, cool. So that's RSUs real quick, right? Let's see. Let me go back to zoom out a little bit. Okay, so hopefully that answers the questions from an RSU perspective. And so the next one that I'd talk about is your employee stock purchase plan. Without going into all the details, I have videos on the basics of all of these. So if you need to catch the basics, then go watch those videos. But with an employee stock purchase plan, the high level is that there's a period where you enroll in it, and then you're actually just saving cash from each paycheck, and then at the end of the period that you're participating in it, there's a purchase date, and you're going to purchase the stock on that one particular date, right? And so in the case of the stock price going down, really the worst that can happen still is that you would be getting the discount on that last date. So that sounded super confusing, so I'm actually gonna go ahead and get back to the whiteboard here. Okay. Erase. We'll just start from scratch. Okay, and switch back to our whiteboard view. Okay, so for an ESPP, in this particular scenario, what's happening is that you start the ESPP while the stock price was higher. And then if your purchase date is coming up soon, then it's going to be lower than this, right? So we'll just say that this is our period where we start participating. All of our paychecks, we're putting money aside for the ESPP, and then it's going to get purchased here, right? And so the way that an ESPP works is that you're going to get a 15% discount on the lower of these two, assuming it has a look back, but the look back saying that it can look back to here. But in this scenario, whenever the stock price falls, then from an ESPP perspective, you're still going to at least have, you're going to get the 15% discount from this price here, right? So even though it's fallen this much, the amount that you're still going to make money on it, assuming that you sell immediately, that you're able to sell immediately. So you still have that perspective, right? So that is, I guess from an ESPP perspective, you don't really have to. It's okay that the stock price has gone down. Is a short way of saying it, right? Okay, so that would be for like any ESPP that you're currently participating in. So now the next one, which might be a little bit trickier to talk through, is what happens to any ESPP shares that you have already bought, right? So in this scenario, if this was the end of a purchase period and you purchased some shares here and then you didn't sell them, right? So what happens in that scenario? And so for this, I'm actually going to look at a graphic that I made from my ESPP video. And it can hopefully illustrate what the way that any held shares are treated from a tax perspective. So too bad I don't think my pointer can work here. So what this is showing is, yeah, there's the enrollment period. On the offering date, it was $10 a share, right? And then on the purchase date, the stock price went up to $15 a share, right? And so what happens on that purchase date is it still got 15% discount from the lower of those two, since it had a look back, and so it got purchased at $8.50 a share. And so, yeah, assuming we don't sell it immediately, this next wavy line here is illustrating what would happen, as the stock price moves. So in our example, with your company's stock price going lower now, the way that it works is if you sold it just at this bottom of this first dip here, then you still realize income from the space of this $8.50 a share that you bought it at, and anything above it, right? So that's still considered income to you, assuming that it's in these short-term windows, right? But the scenario that's not shown here is if that stock price has actually dipped below this $8.50 per share, then the way that that's going to be treated, if you sold any of the stock below that point, then you'd be able to take a loss on that on that sale, right? So before that, you're still realizing income because your what's called your basis is that $8.50 a share. But if it's gone down so much to where it's below whatever your basis was, then you can claim a loss from that perspective. Okay. Hopefully that helps explain that version. Okay. All right. So we talked about RSUs. We talked about your ESPP, right? So next, it's going to get kind of heady. So we'll see how this works. We're going to talk about non-qualified stock options. So again, I just did a video that talks about non-qualified stock options, but really with those, I guess it would be helpful to illustrate this. So with stock options, then you're going to have an exercise price, right? So we're going to say that our exercise price is $10, right? And then we don't have to worry about, we're not going to worry about vesting or anything like that. And then, and I should also say that we're assuming that we're at a public company, so we're not messing with private company stuff. And so with your stock options, that, you know, if your stock price was high and you had a lot of the options had a lot of value, so there's a pretty big space here, right? So this is saying that it's really in the money, right? Oh, let me zoom in here. Yeah, so it'd be saying that we're in the money here, and so whenever you're well into the money, then that's whenever your options have a lot of value, and as soon as you exercise them for non-qualified stock options, so these are NSOs. So as soon as you exercise them, then this spread is considered income to you, right? And so if what has just happened where they used to be really in the money, but now they're starting to get really close to your exercise price, then now the actual value of these options, they've gone down actually in a more exaggerated way than the actual stock does. So in that video, I talk about leverage and the power of leverage. So that works in both ways. Whereas, you know, as the stock price goes up, your option goes up at a higher rate. But then also in the opposite way, whenever it goes down, then your option value goes down just like in more accelerated, more quickly, right? And so one thing that I talk about in that video is that whenever your option gets close to your exercise price, where there's not a lot of value in it and there's a whole lot of leverage in it, then down here it gets to the point where you just it's generally better to wait it out. I realize I just didn't do the disclaimer at the beginning. I'll do it at the end. That this isn't investment advice. So whenever you're down here, then it's generally better to just wait it out, because exercising here, you lose your leverage, and you've realized some tax or some income, but you've kind of lost the power of the option. And then, just to be completely clear, if the stock price has gone below your exercise price, then you definitely don't want to exercise it, because this option has absolutely no value whatsoever, because it's saying you could buy it at $10, but on the open market it's, say, $7, right? So you would never exercise that option whenever it's below your exercise price. Okay. So those are non-qualified stock options. So now we're going to get a little bit more complicated and talk about incentive stock options, right? So incentive stock options, the structure of the option is still the same. You have the exercise price and the vesting schedule and all that kind of stuff. But the twist with incentive stock options is this idea of trying to exercise it, but then hold on to it past a couple of dates in order to get better tax treatment, get preferential tax treatment. And so just the super quick version of it is, if you exercise it here and hold on to it past a year from the time you exercise and 2 years from the time that is granted to you, then this spread gets taxed at long-term capital gains rather than ordinary income. So it could save you a lot in taxes, right? But the catch with ISOs is that whatever, if there's a really big spread here, this amount gets plugged into the AMT calculation, and so you could actually trigger having to pay AMT even though you haven't sold the option and don't have them. You might have to come up with the money some other way, right? So one thing that it's kind of up for debate, and actually, if there's any financial planners that are watching this right now, I'd be interested to get your take on it right now. As far as if the stock price has gone down and is now close to the exercise price, from the AMT perspective, it would actually make sense to exercise there, because whenever you exercise while you're close to your exercise price or your strike price, then the amount of money that is subject to AMT is a lot smaller. So you can exercise a lot more options and not trigger AMT or minimize the amount of AMT that you have. So that's one spin on your stock price has gone down, and so you can somewhat take advantage of that from an ISO exercise perspective and an AMT. But there's the risk that you're really close to that exercise price and you could pay money to exercise it, but then the stock price doesn't rebound and it just keeps going down, and you've just you don't see any reward from the money that you put up from exercising, right? So hopefully that part makes sense. And then the last thing that I want to say around ISOs specifically is in basically for the last several years now, I feel like there's been this recency bias of, well, the stock just goes up, right? I mean, a lot of these tech stocks have done well for so long that we kind of this is somewhat of a reminder that it's like it doesn't always go up, and sometimes it can go down pretty sharply, right? And with ISOs, this whole I sometimes flippantly say you're playing the game of exercising, holding on to it, and then selling later in order to try to get that long-term capital gains. This is just a reminder to weigh the risk and reward of that, because while yes, doing that you can save from a tax perspective on this spread, there's a point that's not too far where if the stock price just goes down more, then it crosses over the benefit of saving on the taxes, right? So for people that have ISOs out there, and if they have a lot of value in it and you have a use for the money, there is nothing wrong with just exercising and selling it, paying regular income on that, and not playing the game of trying to get that qualifying disposition of ISOs, right? So just wanted to kind of put that out there as a reminder of just what can happen with the ISOs, right? So anyway, so like I said, I was just doing this, burning through it really quick. So we talked about RSUs, we talked about ESPP, and then we talked about both kind of options, non-qualified stock options and incentive stock options. Hopefully this has helped. And then the last thing that I want to touch on, and just from this emotional perspective, like it's very difficult to take your emotions out of it whenever your company is going up and down a lot. But that's one value, and I'm not plugging myself or anything like that, but just like having a plan that that you can stick to at least for, say a year period that says, okay, this year we're going to, we're just going to sell our RSUs immediately. We're going to do this with our ESPPs. We're going to do this with our options. Then being able to do that will greatly lessen the amount of possible regret that you would have on, like, oh, I should have sold more here, or I wish I would have done this differently, right? Because that happens more whenever you're just making decisions just strictly based on emotion. But if you put some logic behind it and say, okay, this is the plan, this is what we're sticking to, then while it doesn't completely remove any sort of emotions out of it, you're still going to feel it if the stock price gets cut in half or something like that. It can definitely help from the perspective of reducing the amount of regret, reducing the amount of stress that you have, the amount of anxiety, right? So that's my final plug for that. Okay, hopefully this was helpful. I know I breezed through a lot of stuff really quickly, and like I said, I should do the disclaimer that all of this is just general explanations and education, and there is no specific tax, legal, or investment advice. And yeah, consult with your own advisors if you have questions on any of that stuff. Okay, all right. So thanks. We'll be back in a couple weeks. Going to have Meg Bartelt on in a couple weeks. So I'm super excited about that. And I will talk to you guys later. All right. See ya.